Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Hi everyone, my name is Sujay Shah, and I'm the Global Head of Cleantech Sector Coverage at Standard Chartered Bank. Thank you all for joining us today and wish you a very warm welcome to our panel discussion on mobilizing institutional capital to finance energy transition in Asia. We have a great panel lined up, which will provide us perspectives across the entire investor landscape. So let me start with a quick introduction, starting from left to right on my screen. We have Eric Francia, President and Chief Executive Officer of AC Energy. We have Michael Dennis, Managing Director, Head of Alternative Strategy and Capital Markets, Asia Pacific at BlackRock. And we have Audra Lowe, Chief Executive Officer and Executive Director, Clifford Capital. Before we start, a couple of housekeeping points. One, throughout the event, you will be able to submit questions online to all the panelists or direct them at specific panelists. We are very keen to have a two-way conversations with all of you. So please do feel free to type in your questions and we will try our best to weave them in. Number two, a reminder for everyone, but especially the panelists, this conference will be recorded and hence we will request you not to share any private information. So without further ado, let's get straight to the topic on hand, institutional capital and energy transition. To set the scene, Asia Pacific is clearly the undisputed engine of power demand globally, and hence it's not surprising that it's now right at the center of the global energy transition debate. Wood Mackenzie has estimated over $1.5 trillion will be required to be invested in Asia for energy transition during this decade. Interestingly, this is more than the investment in all the other regions combined. But while the Western world drives the sustainability agenda, many questions as far as Asia is concerned are still unanswered. Southeast Asia in particular has plenty of cheap coal. Does it really need to prioritize cleaner power over power access? Does gas have a role to play as a transition fuel? And most importantly, over the longer term, how can institutional capital be mobilized to enable a just transition? So lots of exciting questions, and let's get to the views straight from our experts. So Mike, I'll start with you. More than 60% of the electricity generation in Asia right now is driven by coal, and power access and affordable power are critical, particularly for emerging Asia. How do you see the debate around energy transition?
Thanks, Sujay, and thanks to Standard Chartered for inviting me today. It's great to be here talking on this topic. I think just to set the scene, I think we need to be aware that the conversation on decarbonisation and the role of fossil fuels versus renewables is very different for the developed market and for the developing. And we see a divergent decarbonisation path reflecting the different stages of really economic development. I think what we see is that developed nations are focused on greening their existing power mix and they're really coping well with the additional demand for electrification. Whereas the emerging markets, as you called out, by contrast, are experiencing rapid growth of power demand to match their rapid economic growth, which is driven by population and consumer growth and many of the factors that we all see every day and we frequently read about. I think that we have therefore seen that emerging markets are really looking to install new, larger power capacity rather than necessarily just the greening of their existing. We saw that the capacity grew by 79% since 2010, but ultimately 40% of that new capacity was from fossil fuels. And coal still accounts for 44% of all power generation, really in the emerging markets today. Which, when we think about what the narrative is and what we see in the media, this is in stark contrast to what we see in developed nations, which has effectively installed zero net new coal-fired capacity since 2012. And wind and solar alone accounted for 95% of all new capacity that was commissioned in developed nations last year. Therefore, I think this whole conversation of energy transition is critical. Because if we look at the significant opportunity, we see there could be as much as $5 trillion of investment required over the next 15 years. But I think as we need to actually talk about this in separate conversations between developed and emerging to marry the needs of each individual country with the priority of moving to net zero and the changing role of fossil fuels. But perhaps I'll pause there and pass back to you, Sujay.
Thanks, Mike. And just to stop where you ended, Mike, around fossil fuels, Audra, I'll bring you in. And gas has attracted a lot of attention as a transition fuel. And increasingly, what we are seeing now is that financing, even for gas, is getting tougher. The development banks are now either phasing out gas financing or setting stricter standards. How do you at Clifford Capital see this playing out generally as an institutional investor as well?
Thanks, Sujay. I think the question is still out there for gas financing. And I don't think institutions have necessarily completely ruled out gas in the same way that they have done for coal. I think coal has actually gone through a remarkably rapid transition where 2 years before today, there are still a handful of institutions, banks, and including institutional investors that are prepared to deploy capital to financing thermal coal projects. But as of today, I think that group is rapidly shrinking to just a very small handful. From what we can see, it's really only the Chinese institutions that are prepared to finance coal projects these days. Whether gas is going to go down the same path, I don't think we really have clear answers on that count just yet. It's also probably pretty unrealistic to expect Asia to completely turn away from gas overnight as rapidly as it has done for coal. And as you said at the beginning of your introduction, 60% of thermal power is still running on coal. I do see gas as an intermediate solution as we move into greener technologies. So with that being said, there is capacity to potentially repower existing coal assets, for example, hopefully into cleaner fuels in the interim before they are then, retired and with green technologies replacing them altogether. So that means that there is still very much a role for banks and for institutional investors and other capital providers to continue deploying their investments towards gas, very much as a transition fuel.
Thanks, Audra. And to bring in the greener element, Eric, your company, AC Energy, has been right at the center of energy transition, sort of transitioning from increasingly the fossil fuel towards a greener future. So how do you see the energy transition opportunity in Asia, and what are the areas you're specifically looking to pursue?
Yeah, thanks, Sujay, and good afternoon to everyone. Yes, the energy transition is definitely upon us, even in this part of the world. While I agree with Mike that it's quite different in terms of the pace of transition between developed and emerging markets, you see governments making a move as well. We last year we saw the Philippine government put in a coal moratorium. And then just quite recently, just a month ago or so, Indonesia following suit. So I think that's a massive shift in these markets that really beg the question for the next technology that will replace coal. And I think I agree with my fellow panelists that renewables and storage alone cannot fill in the gap that will be left void by coal. I think gas has a role to play. I think what it's going to be is that gas, from a technology that is typically seen, at least in this part of the world, as serving mid-merit and peaking complementary requirements due to the intermittency of renewables, I think they will now have a role to play in the baseload space. And what's good with gas is it's flexible enough to be able to complement the intermittence of renewables. But that being said, I think there's a lot of countries that are being more aggressive with the greening of their grid. We've seen Vietnam make a massive push on renewables with a very aggressive feed-in tariff. Those days will be over. It's a matter of when and not if. So we need to prepare for the next phase of policy in Vietnam. People are gearing up for the auction system. I think in Southeast Asia, Philippines has moved towards a renewable portfolio standard. So we have geared up heavily on that as well. And the third market in Southeast Asia, I would say that warrants increasing attention is Indonesia. A lot of people have been waiting for the feed-in tariff and renewables policy. I think the recent announcement on coal is a good one. It's a good signal. We're still waiting for the policy. I think it's a market waiting to happen, and I think there's going to be a lot of focus and attention on Indonesia.
Eric, and I'll stay with you. Thanks for the insights. One question for you is, as you think about the opportunity that you mentioned across all these markets, is capital available easily for developers who want to develop these projects? And number two, is there a role for institutional investors to fill in any gaps that you may see?
Yeah, I think it really depends on the market and the project and the investment. I think in the case of Vietnam, for example, I think most of people know that non-recourse project finance is a challenge given the imperfect nature of the PPA. It's not up to global standards, but for some emerging players like us and the relationship banks that we have, it is good enough. It's not vastly different from PPAs like in the Philippines. As an example, grid curtailment risk is borne by the generator. That risk is borne by the generator. You can mitigate it through various ways. So I think project finance is definitely a space where we thought we could add a lot of differentiated value. I think the challenge for institutional investors as well is the size of these deals. We love scale. I'm sure a lot of institutional investors love scale. There's a minimum size requirement to get out of bed, so to speak. So I think one of the roles that organizations like us can play as well is one of sort of an aggregator role. We have varying sizes of projects. Our smallest would be 30, 40 megawatts, whether it's solar or wind. But we would rather focus moving forward towards more of the large-scale projects. In Vietnam, we're building the largest wind farm that's 252 megawatts. We have one of the largest solar farms in Vietnam with 410 megawatts. So those are the types of scale projects that we would love. And but notwithstanding, we also tap the debt capital markets. It's an emerging. There's a lot of interest, obviously, from ESG investors. So I would say that there's a lot of opportunity in debt capital markets. You would need scale, maybe a portfolio or large-scale projects to be able to tap that opportunity. There are opportunities in structured financing, but that's more of a boutique niche play because these are largely more complicated. So it takes more time to structure. And then on the equity side, I think there's still a dearth of opportunities. There's not a lot of pure play or largely renewable platforms out there, which is resulting in a scarcity value. And that's why we have repositioned AC Energy from 3-4 years ago, where we were bigger on thermal. That's how we started the platform 10 years ago. But in the last 3 to 4 years, we've gone through a transformative phase and really focused on renewables. So I think there's going to be others who will be following suit in terms of repivoting their platform towards more renewables. So conversely, there's going to be more opportunities for equity investors as well over time.
Thanks, Mike. Thanks, Eric. Mike, I actually saw you smiling when Eric referred to the scale sort of challenge for institutional investor. BlackRock obviously has been sort of one of the largest investors in some of the green bond issuances that have happened out of Asia. Would be curious to sort of get your view around Asia being a very large energy transition market. But so far, we generally haven't seen a lot of institutional capital, unlike Europe and US. So could you talk through some of the key barriers that you see from an institutional investor point of view?
Yeah, thanks, Sujay. And the reason I was smiling is obviously at BlackRock, we were in a number of different areas. And I think we were both an investor from an infra equity perspective, but also within the green bond space and across private illiquid debt around the infrastructure space as well. So we see opportunity in all three. But I think in answer to your question on the barriers in Asia, I'll approach it really from an equity perspective. And I think there are three areas I'll call out. Number one is actually a need for more capital. Yes, there's a demand for big deals, but there needs to be more private capital in the right structures for investing in Asia, number one. Number two is we need a change in some of the regulatory frameworks in the region. And number three is really the need for investors to be more local. I think the idea of global funds allocating locally, you need local network and local alignment. So let me just double click into a couple of those, is that starting firstly on the need for more private capital rather than necessarily just big deals. I think that in order for climate infrastructure to evolve in the emerging markets, we see a sizable gap in what's being raised in terms of global funds versus what's actually allocated to local challenges. So we need private capital that's raised alongside public capital in accelerating investment flows into energy transition. And we've seen that steadily started to increase year over year. But when the pandemics hit, we've seen that there's been cautiousness among LPs about allocating to newer strategies or to build outs happening in the same pace within the local market. On the regulatory side, we obviously see that in many emerging markets that there's a less developed regulatory framework. So this becomes a real barrier for when you're trying to account for local environmental and social impacts, and also trying to assess the local community. You really need to see a large allocation of capital. You need a robust framework in order to identify and also manage the risks that emerge and which institutions are looking for in order to clear their governance around their funds. And then finally, one that I think is really coming to bear through the pandemic is the complexity of the kind of local stakeholder management. I think many large institutional investors have had global capability that they've applied locally. I think really the need is to understand the local community, to understand how it affects stakeholders is a really important part for ramping up the institutional capital. Because if you don't understand and if you're not present locally, you can't understand some of the elements around project construction and development and real financial impacts of local issues. And so I think when you look at these three barriers, they may not be obvious because of the amount of money that's being raised focused on energy transition or renewable energy. But in order to see money actually getting to where it's needed in terms of capital on a per project level, these are the three barriers that we see really gating a significant ramp up in the allocation of institutional capital.
Thanks, Mike. Quite insightful around the challenges. In fact, interestingly, we've just had one more question coming from the audience around the challenges. And this one says, outside of carbon, how are lenders, investors, and maybe Eric, in case you want to take it up, developers considering other environmental risks, for instance, biodiversity, water access, indigenous lands, community resistance around greenfield renewable projects, particularly on hydro? Does anyone of you want to take it up?
Yeah, it's definitely a consideration. AC Energy doesn't have hydro projects per se, but in the solar farms and the wind farms that we do, a lot of them greenfield, as you say, Sujay. Yes, definitely we are aligned with the global standards in terms of environmental and social management. So we do have an ENS policy. We've worked with both IFC and ADB to craft and to roll out that policy. So issues around biodiversity management, forest protection, circular economy, dealing with IPs, relocation, resettlement of landowners, and so forth, are all aligned with globally acceptable practices. So these are important elements. It's not enough for us to build renewable energy. You have to build it in a sustainable manner.
All right. No, very helpful. I think. Go ahead, Mike.
I was just going to add to that is that I think it's the important part of stakeholder engagement and stakeholder management is when you're trying to capture these broader issues such as biodiversity or the impact on indigenous peoples, it's really to outline up front as you look at going into a project, the stakeholder groups and detailing a plan to really engage and consult with each of those groups. And I think when you think about traditional allocations in asset management, to have consultancy beyond actually the investment, this is a big step for the industry. But actually, if we're going to see scale deployment and really private capital fulfill the role that it's going to need to drive energy transition and the advancement of renewables, this stakeholder management alongside an investment approach is going to be critical.
So I was also going to add to that, as an institution that spends a lot of time financing greenfield projects, we spend a lot of time thinking about ESG issues as well. We have an internal ESG policy, which we use to screen our deals. And we deal with issues that are mentioned by Eric and also by Michael, whether it's about what the environmental impacts are on with the various projects, right down to what groups are being impacted by these investments. So talking about the very things that you were saying, Michael, stakeholder management, how do they come out better as a result of these investments? So these are just things that we do regularly consider as part of our normal lending process.
Got it. No, thanks. Actually, it was very good question. So thanks for bringing that up. Now, moving to a slightly more controversial sort of topic is around the valuations these days, and more particularly around thoughts of a bubble. So, Eric, we do sort of feel somehow of that there is a bubble brewing in some parts of the sectors as an ever-increasing pot of ESG money now chases a very small number of viable opportunities. How do you think this can be tackled, and what role can all of us play to ensure that this sort of bubble doesn't pop?
Yeah, I think, first of all, the scarcity value is something that is temporary, I believe. There will be more companies, more options that will appear in the horizon. Having said that, the ESG pool of funds is just growing at an exponential rate. So I would caveat what I'm saying by, these investable platforms may not be able to keep up. So there is a risk. But having said that, I think one needs to mind the balance sheet. I would go to the fundamentals, and as long as the investors will take a strong view on the balance sheet strength of these companies, number one. Number two, while the market is ascribing a high growth assumption, you've got green companies fetching at 15 to 20 times EV/EBITDA multiple, which sometimes even higher, really implies that there is a lot of growth expectation. So that puts a pressure on companies to grow. And I think I would caution also that the discipline needs to remain, in terms of the return profile of the projects. And I do recognize that is a risk. We are very conscious about that, not to go crazy with, low, mid, single-digit returns. That's why we're very selective of the key markets and projects that we participate in. Last and not least is the interest rate differential. Again, a bubble could burst if there is a mismatch, obviously, between interest rates and the underlying project returns. We know that bubbles burst typically when and not if interest rates turn the other way or increase. So again, at AC Energy, we want to make sure that we lock in low interest rates for a very long time, as long as perpetual. We do have fixed for life perpetuals as well, or project finance would typically be in the 10 to 15 year range, and we typically want to lock in fixed long-term interest rates where possible. So I think having a disciplined approach in terms of discount rate, interest rate matching, and underlying economics of the project are key to make sure that we stave off any bubble bursting.
Thanks, Eric. So it's actually a perfect segue to get Mike to the next question I was planning to ask him, was around the interest rates and how that impacts energy transition, and more particularly, how would he see a risk of capital flow back to the US or developed markets?
Yeah, so I think as we look at the potential for higher interest rates and how that might kind of impact energy transition, I think it's very relevant given what we've seen in, I think, recent weeks. This is obviously happening in live when you look at the macro concerns around inflation. I think we need to understand, and I think maybe we'll come onto this a bit later in kind of the flows into EM debt, but we have to think of there's regional investors and there's global investors. Because I think when you look at regional investors, we see many of our lenders coming really out of Korea, out of Japan, out of Taiwan, where we see high liquidity for climate assets. And I think that the parameters at which those lenders are available to us as equity investors is very different to, I think, some of the interest rate dependency or sensitivity that we see from global investors. And so what we see is, on top of that kind of regional global difference, is we're seeing increasing base rates are being somewhat offset by decreased margins as local lenders are becoming more comfortable with asset classes and the level of competition intensifies. And so when you see that, that means that there's these hidden factors beyond just the macro that we see with interest rate news. On top of that, and as a kind of final point, is that we see that climate assets in Asia tend to be supported by a pretty strong contractual revenue profile, which actually is quite different from the US and Europe, which I think for many of the lenders gives increased comfort about bankability and confidence in developers and the projects they're putting in place. And I think the approach we therefore take is, at BlackRock, we're really trying to understand, looking at all these factors, how is that going to impact the long-term cost of debt? And how do we apply that when you look at the energy transition opportunity, and how that we build for the long term in the relationships that we have, and how do we align then underlying equity returns against that lending backdrop?
Mike, you bring up a very interesting point around sort of falling spreads, particularly as local banks in Asia get more comfortable with the energy transition sector. And I can promise the audience that the answers haven't been choreographed before, but this is exactly the point I was actually going to ask Audra about. So Audra, I think the bubble we see is not only on, I guess, the investors, sort of the developer side, but also investors. But equally, I think from a bank perspective, we are seeing a big rush for lending to green or renewable energy projects. How does Clifford Capital's interactions with some of these lenders work in terms of competition? Does that increase the pressure on you in terms of the opportunities to chase for?
I mean, it does to a certain extent. So Clifford Capital, we are a non-regulated financial institution. So that actually sets us apart from other banks. Because we're not regulated, what we have tended to find is that we are a little bit more competitive in providing long-term cross-border financing solutions. And we are also a niche lender focused very much on the structured finance, project finance space. And we are able to basically deploy our expertise in structuring financings that are well suited to these projects, especially some of the newer forms of these projects as they move away from long-term PPA into more distributed type power generation projects. What I would say is that because there's so much interest in green projects these days, it's the same thing that's happening to the equity markets. Yields are falling, spreads are falling for lenders as well. And what is actually potentially scary for lenders, given that the returns in general are so much lower than for equity, is that there is an increasing propensity to take on more risk as lenders. You would have heard by now that there are still contracted projects around Asia. There are imperfections in many of these PPAs. There's no compensation for termination risk. As Eric mentions, there's curtailment risk that's not necessarily properly addressed in this PPA. Lenders are starting to be prepared to take a view around this, and one of the ways they've been doing this is to also rely on the strength of the sponsors that they are supporting. And actually what this then does is that it only allows perhaps the strongest sponsors to be in a position to develop many of these projects. And as a policy lender supporting Singapore companies, whether they are large or small, what we do find is that it prevents perhaps some of the smaller aspiring companies from coming up the chain and also developing more of these projects. So I would say that from a debt perspective, I think this bubble is potentially scary, not just because of returns, but it could be long-term unsustainable if some of this risk actually does play out and it causes a lot of credit loss along the way.
Fascinating insights. Thanks, all three of you. I think it's clearly a topic, the bubble, which is increasingly getting more and more attention. Now, shifting gears, and I'm just going to weave in one of the questions that has come with respect to when we're talking about energy transition. People talk about solar and wind, but equally, I think there are other viable or potentially viable alternatives. The question from the audience is specifically around renewables, but even beyond that, there are opportunities in terms of green hydrogen, batteries, etc. So, would be curious to get Eric, your views around some of these newer technologies and how AC Energy is looking at the opportunity there.
Yeah, Sujay, the way we view it is actually related, inextricably linked to the renewables scale up. You said solar and wind. It will be hard, if not impossible, to scale up solar and wind in a way that we would love to scale it up without battery storage at a minimum. One of the key constraints or barriers to the accelerated expansion of intermittent renewables is the limitations of the grid. No, in many markets, not just the Philippines and Vietnam, but even Australia, there are grid limitations. And as you very well know, battery storage is one way to unlock and address any limitations that the grid may have. So definitely, and it hits two birds with one stone. One is that to address limitations of the grid, and the other massive benefit is to address the intermittency and make reliable renewables more reliable. So the magic number that we see there on battery storage is the proverbial $100,000 per megawatt hour. Today, I think we are in the sort of the $250,000 to $300,000 per megawatt hour, depending on how many hours of storage. At this level today, battery storage is already competitive if you use it for grid services like frequency regulation. We think it has to come down further, closer to $100,000 per megawatt hour mark if it were to be used for firming renewables and making it more reliable, i.e. the load shifting use. So we believe that it will take probably 4 to 5 years to get there. But it's funny that we always say 4 to 5 years in the last 3 years or so. It's still 4 to 5 years. But hopefully that acceleration of efficiencies and cost decline of battery storage will happen sooner rather than later. Of course, green hydrogen is also the next big thing. It's gotten a lot of attention and interest just in the last 12 months. We are planting the seeds. You need really large-scale renewable installations. That's why countries like Australia are very big into hydrogen. It's blessed with rich resource and so forth. So that's definitely a natural area we would look into, because then that would really address these fossil, obsoleting the fossil fuel. I think will require green hydrogen to really take off. So definitely looking at that area as well.
Thanks, Eric. So this is again a developer perspective. Mike Audra, would be sort of curious to hear from you in terms of your institution's roles in terms of facilitating the financing of some of these emerging technologies, particularly within an Asian context.
Yeah, I mean,
go ahead, Audra.
Okay, sure. I think for us, again, we do see a role for financing institutions to push the agenda forward. So from that perspective, I almost would risk saying that, we will go against potentially the age-old project finance adage of only financing proven technology. By that, obviously, we're not out here to finance commercially unviable technologies, but things that are on the borderline, we will be prepared to consider. I mentioned earlier that these days we're also thinking about how we can introduce appropriate structures to deal with things like distributed generation, rooftop projects. I think these are things that you can actually think about from a financing structure perspective, and that's where we want to sort of add value to the entire discussion. For newer technologies such as hydrogen, it's areas that we're looking into, not necessarily financing just yet. But certainly we'll be very interested because we see a lot of opportunities coming up. With this new greener fuels such as hydrogen or ammonia, there's a need to transport them from areas in which they're produced into areas where they would be consumed. As a lender that's also active in the maritime and transportation space, we're very interested to understand how this is also going to play out. So we're spending a bit of time just understanding directionally where some of these new technologies are going.
Mike?
Yeah, so I would say that I think the importance of the falling technology costs is going to be so critical for renewables to be embraced much more broadly. I think a stat that we regularly talk about is that solar modules are nearly 90% less expensive today than in 2010. So we just think about that in terms of accessibility, and we think that the installed solar in emerging markets has grown from 1 gigawatt a decade ago to now 325 gigawatts today. So we see the impact of cost. So at BlackRock, what we've really focused on is how do we supercharge that? And so some people on this call may have seen an announcement we made recently on the creation of decarbonization partners, which is BlackRock and Temasek have committed $600 million to invest in companies and proven technologies that will reduce and eliminate carbon emissions. So this is really to focus on equity investment at a growth stage of new technologies and to really ensure that those companies have the required financing and the required partnership. Going back to my point on stakeholder management, of really how do we manage these assets beyond just being help manage these companies grow beyond just being financial investments. And when we look at that, it's really targeting at next-gen renewables, mobility technology, emerging fuel sources, grid solutions, battery storage, etc. Because I think that by actually having decarbonisation emerge as an asset class, that's going to be the catalyst for new technology to really be a catalyst for change, but also for the cost of technology to decrease. And therefore, hopefully, we'll start to see what we've seen in solar happen in other areas, and that velocity or momentum of change will be able to increase significantly against some of the barriers that we talked about earlier.
Right. So it's quite exciting to see, I think, both from a developer perspective as well as a lender or institutional investor perspective, that there is a lot of appetite and willingness to look at some of these technologies, clearly a positive direction. The last sort of question to start wrapping everything up is around how do we actually end up using all this to facilitate institutional capital into Asia. So maybe if I can just have a couple of minutes from each of you, Eric, if I can start with you. What do you think AC Energy has done well in order to sort of secure the amount of institutional capital you all have got, and how should other developers think about it?
Yeah, I think it started really in 2019, Sujay, when we made our debut with the green bonds, tapping the debt capital markets. It was a first step. I think it was an eye-opener for us, and it unlocked a lot of the potential, gave us the much-needed funding to be aggressive with our expansion and doing it early enough. So I think we really received a very strong interest in that particular instrument funding beneficiary. So on top of this, just recently this year, we've focused on the equity side. As you know, we've brought in GIC as one of our major investors. They have 17.5% stake of AC Energy Corp. And then we also did a follow-on offering. Again, a very strong attraction with institutional investors. We had a multiple oversubscription in terms of our follow-on offering, blue chip, long-only investors for most of the part. So again, we're very pleased, and it encourages us to do more. We would like to bring this down to the sub-platform levels over time. I think one of the aspirations we have is if we can do project level or sub-platform levels to tap these capital. But I think, as we discussed before, we would need to get some of these sub-platforms or projects up to a certain level of scale to tap, $200, $300 million at a time. But I think there's a lot of opportunities just in the beginning of this movement. So really, really exciting. as long as we manage that we don't burst that bubble. But I think we're in very good track.
Fantastic. Audra, from your perspective, what would you like to see developers doing more for you to be able to deploy more capital in the region?
I think developers are doing plenty to look at so many of these projects. So I think that's actually very exciting. Where we hope to bring a bit more value to hopefully bring in more institutional debt capital into this space would be our approach in financing some of these projects. So even though we are a policy lender that has support from the Singapore government, we are still very much a commercial lender. So we structure our deals so that they are palatable by commercial institutions as well as banks. When we do work in emerging markets such as Vietnam or in Philippines, for example, and also in Indonesia, I think we can definitely think about how we can address some of the concerns that many institutional investors have, which very often is due to a lack of understanding around regulatory frameworks and things like that. If we go deeper into frontier markets such as Laos or Myanmar and Cambodia, and we actually were one of the first financiers for a power project, albeit a fossil fuel gas-fired one, in Myanmar, again, we can deploy that kind of thinking into bringing more institutional investors into these kinds of markets with the use of political risk insurance, for example, and working with the likes of many of these multilateral development banks. So that's the kind of role that we want to see for ourselves in crowding in more of these institutional capital going forward.
Thanks, Audra. And Mike, we're drawing to a close. I'll give you a closing comment around what BlackRock would like to see more from Asian developers in order to be able to deploy much more capital in this part of the world.
Yeah, thanks, Sujay. I think for developers, I think to best position themselves to raise more institutional capital, I think there's a couple of things I'll call out. I think number one is understanding the investment process of the change in capital that's coming into the market in terms of time it takes to do a decision, making a long-term investment, putting the long-term investment in place. That's number one. Number two is to consider partnering with institutional investors on a full pipeline basis in order to rapidly monetize development assets with secure funding, because I think a competitive auction for each single asset may achieve a great one-off result, but it lacks the scale that we've been talking about today and this high transaction risk that would attract interest, I think, from larger players. I think going back to our point on technology, don't cut corners on technology. Proven technology will come at a cost premium and it will be a binary requirement for institutional capital. And then finally, I think really to consider multiple income streams from assets, as opposed to an upfront sales consideration only as a way to monetize projects. We see that developers unwilling to entertain common sense risk shares or consideration structures can cause real transaction failure. But I still believe that a lot of that rests on institutions. I think being able to come to developers as good partners and actually having the right capital set up. And so and I get asked about climate change every day by our clients. And so it's the top priority every day when we have meetings with them. And so I think at BlackRock, we're really focused on making sure we have the right structures, the right team set up to be able to work with developers in each local market. And as an example for that, we, at the end of last year, launched the Climate Finance Partnership, which is a creation of a public-private partnership with the governments of France and Germany, as well as 3 major charities, in order for now us to position capital to accelerate the flow of private capital into climate-friendly infrastructure in emerging markets. And I think when you have this adoption by developers of understanding what institutions are looking for and how to partner, and also the creation of capital in the right structure with the right teams, these are the core components, I think, that to see the deployment and the scaling up within Asia Pacific and within EM, if those 2 things can happen, then we should be on the cusp of some major opportunity and change.
Great. Thanks, Mike. That's a great way to sort of end the discussion. It's been absolutely fascinating. The key takeaways for me are, number one, energy transition is a complex topic, particularly from an Asian context. Number two, there are quite a few challenges that investors and developers need to keep in mind from an Asia perspective, not least things like scale, curtailment, off-take risks, etc. But three, despite the challenges, what's clear is that institutional investors have a very important role to play. And that role not only exists to mature technologies, but also sort of emerging technologies as well. So to wrap up, I'm quite optimistic and positive. As you heard, Eric, if you have the right sort of projects, and as you heard Audra and Mike, that once you have those projects, there is enough keenness from institutional investors to deploy capital in this part of the world. I'd like to thank the panel for your expert insights and setting up an extremely informative and lively discussion. Lastly, thanks to all the members of the audience for tuning in. We hope you found this interesting and insightful. We appreciate you making time out to join us. We have a great lineup of panels coming up over the next 2.5 days, so please do tune into those. That's all from my side. Goodbye and stay safe. Thank you.
Thanks, Sujay.
Thank you.
Thanks, everyone.
Thank you, Sujay.
Thank
Take
you.
care.